Let's travel back in time for a second. The year is 1650. We're looking at a tiny nation, just 2 million people, but it is without a doubt the wealthiest and most powerful financial center on Earth. Its currency, the guilder, is the global reserve. Their ships dominate half the world's trade. I mean, from the outside, they look completely invincible.
But fast forward less than a century, that incredible empire was bankrupt. The guilder was in a state of collapse. And that brings up a really serious question, one that we have to explore today. Could the United States dollar be following the exact same historical playbook?
To really dig into this story and get more insights into the global currency market, make sure you like, share, and subscribe to the Global Finance Archive channel. We're breaking down the patterns that define global finance, and trust me, you are not going to want to miss what's coming next.
Okay, so to even begin to understand the parallels to our world today, we have to go back to the absolute peak of the Dutch Golden Age. And we're not just talking about wealth here. This was a level of economic dominance that literally reshaped the entire world.
Just try to wrap your head around this scale. The Dutch East India Company, also known as the VOC, was the world's very first multinational corporation. At its height, its value was the equivalent of a staggering 7.9 trillion of today's dollars. To put that into perspective for you, that is bigger than Apple, Microsoft, and Google combined.
And this wealth wasn't just at the top. In 1650, the Dutch per capita income was about 1,300 guilders. Now compare that to England, which was at 800, or France at a measly 600. The average Dutch citizen was dramatically wealthier than their counterparts in much, much larger countries.
And the engine powering this entire empire? It was the Dutch guilder. This was the world's first real global reserve currency, and it was backed by physical gold and silver. You could literally walk into the Bank of Amsterdam and exchange your paper notes for precious metal. That made it the most trusted currency on the entire planet for any kind of international trade.
But you know how it goes. Immense success creates immense conflict. To protect those lucrative trade monopolies, the Dutch Republic found itself in a near-constant state of war. For over 100 years, they fought England, they fought France, they fought other powers in a series of incredibly expensive conflicts. And this, right here, would become their fatal flaw.
So here's where we start to see the first cracks appear. In 1650, right at their peak, the Dutch public debt was a totally manageable 30 million guilders. But those wars started to take their toll. Just 20 years later, that number had more than doubled to 80 million. And then came what the Dutch call the disaster year of 1672. By the time that war ended, the debt had absolutely exploded to 200 million guilders. That's a 566% increase in less than 30 years.
And after one last disastrous conflict, the Fourth Anglo-Dutch War, it hit a catastrophic 455 million. That was 22 times the entire annual revenue of the government. The debt had become fundamentally, completely unpayable.
The conclusion is just inescapable. The very nation that gave us modern finance, we're talking central banking, stock markets, the whole shebang, was brought to its knees by that classic imperial cocktail. Too much debt, too much war, and finally, the loss of its reserve currency.
Now, as we make the jump from history to what's happening today, just a quick reminder for everyone, this AI-generated explainer is purely for educational and entertainment purposes. This is not financial or political advice. All these historical comparisons are, of course, theoretical, and we always encourage you to do your own research.
You see, what's so fascinating about this, so compelling, is that the Dutch collapse wasn't some random, chaotic event. It followed a predictable, almost mechanical pattern. A sequence of events that has actually repeated itself with empires all throughout history.
Let's just walk through that playbook step by step. 1. Massive debt accumulation from constant wars. 2. Currency debasement to try and finance that debt. That's a fancy way of saying printing money that's not backed by real assets. 3. You lose your reserve currency status as global trust evaporates. 4. Your financial system collapses. 5. You become vulnerable to invasion, which leads to 6. The loss of national independence. And the final step, 7, the forced liquidation of your national assets.
Okay, so in a moment, we're going to apply this exact pattern to the United States today. If you're finding this analysis valuable, now's the perfect time to hit like, share, and subscribe to the Global Finance Archive channel so you do not miss what comes next. Which brings us right to the heart of the argument. Is the United States walking down this exact same path? So let's apply this historical pattern directly to America's current economic situation and see how it holds up.
Honestly, the parallels are pretty striking. Let's just go through the metrics head-to-head. Dutch debt increase, 566% in 28 years. And the United States debt increase, a projected 540% in 26 years. The Dutch currency backing went from full gold backing down to just 33% metal. Well, the United States went from the gold standard to a fiat currency backed by nothing but a government promise that's 0% physical backing. Dutch interest payments ballooned to 50% of all government revenue. Today, United States interest payments are greater than the entire defense budget. And finally, the guilder lost its reserve status to the pound, and the dollar's share of global reserves has already fallen from 71% down to a projected 55%.
Let's really zero in on step 3 of that pattern, the loss of reserve status. I mean, look at this. In the year 2000, the United States dollar made up 71% of all global reserves. That number has now fallen to just 55%. This is a clear, undeniable trend of de-dollarization, as other countries are actively looking for alternatives.
And the other parallels are just as direct. Over $8 trillion in debt from wars since 2001. A 600% increase in the money supply since 2000. Annual debt service costs are now over $1.028 trillion. And you've got structural trade deficits of around $800 billion every single year. The pattern is, well, it's aligning.
So the whole point of this entire comparison, this whole historical deep dive, is to serve as a warning. It is not a prediction, but it is a very clear look at a recurring historical pattern that seems to end in the same place every single time. And if there's one key takeaway, it's this. Reserve currency status is not permanent. It is earned, and it can absolutely be lost. And history shows us, time and again, that once a nation loses that status, it never gets it back. The guilder never recovered, the pound never recovered.
Which brings us to the final, and frankly, very sobering question. The Dutch were forced to sell off their colonies, the British had to liquidate an entire empire. If this pattern holds true to form, what assets does the United States sell when the debt becomes unpayable?
It is a heavy question, for sure, but it's really at the heart of this entire analysis. So what are your thoughts on this historical parallel? Let us know what you think down in the comments. And to continue this conversation, please be sure to like, share, and subscribe to the Global Finance Archive channel.